Welcome back to the ABC News. I'm your host Jennifer Pham, and we'll be bringing to you the cash rate prediction special tonight. As of the first Tuesday of October, the Reserve Bank of Australia will be meeting once again to discuss the following monthly cash rate. Tonight we'll be bringing in specialists to discuss the prediction. Here in Melbourne tonight, we are joined by Stuart Herbstreit to discuss inflation. Stuart, what's your prediction on the RBA cash rate?
Thanks, Jen. The current inflation rate figure of 1.9% is marginally outside the Reserve Bank of Australia's target rate of 2 to 3%. This has remained under 2% for 10 of the last 11 quarters. The main two factors holding the inflation rate below target currently are cost push factors, historically low wages growth, and increased oil and electricity prices. As oil and electricity are key inputs in Australian production, increased cost prices in oil due to global shortages have been passed on to consumers to maintain profits. Further, electricity prices increasing have increased production costs for businesses throughout the economy. Historically low real wages growth has been due to underemployment in Australia, where there is spare capacity, and structural weakness with a need for Australia to be more competitive. Weak real wages growth means that Australian households have decreased buying power, and as such, products have become relatively more expensive. If the RBA decreases the cash rate, capital will be more accessible, and as such, prices may continue to rise out of control. On the contrary, if the cash rate increases, then there could be a shortage in the supply of money, and prices could also increase. As inflation is at 1.9%, the RBA should hold its cash rate.
Now we move on to Mark Stutz, who is an expert on the housing market. Mark, do you agree with the increase in cash rate?
Thanks, Jen. Look, in my opinion, I don't think the RBA will increase the cash rate. And my recommendation to them, based on the situation within the housing market, would be to keep the rates on hold for the current period. If the RBA does increase the cash rate, the housing market will find itself in a potentially dangerous situation. Already, it has been found that 1 in 4 mortgage households are under mortgage stress, meaning their income is unable to cover their outgoings, which includes mortgage repayments. This situation whereby thousands of households are finding themselves under mortgage stress leads to a much higher risk of defaulting loans, and of course, if this occurs on a large scale, there is a possibility of collapse in the housing market. Similarly, on the counter side, a decrease in the cash rate by the RBA would similarly exacerbate the current housing affordability issue. By reducing the cash rate, we would essentially see cheaper lending and more households able to access and afford home loans, pushing up already strained prices. In cities such as Melbourne and Sydney, housing affordability is already well out of reach for first home buyers, and a cut to the cash rate would only worsen this problem. So overall, Jen, I would recommend the RBA maintain the current cash rate to prevent any unnecessary and dangerous volatility in the housing market.
Joining us live is Travis Garrett from the Department of Foreign Affairs and Trade. What do you believe is the best option for the RBA?
Thanks, Jen. So with respect to the Australian economy and the official cash rate, I believe the cash rate should remain the same. This is because an increase in the cash rate would lead to flow-on effects to banks, increasing interest rates, making it more appealing to foreign investors and thus increasing the demand for the Australian dollar. Furthermore, domestic investors will then want to reduce their investment overseas and invest in assets within Australia, reducing the supply of the Australian dollar, which in turn increases the equilibrium exchange rate, keeping all else equal. While a higher exchange rate allows holders of Australian currency to purchase more, it hinders our competitive pricing within Australia of goods and services and thus reduces the total amount of exports, which could lead to another balance of payments of deficit, which we experienced for an extended period of time between April 2014 to October 2016. On the other hand, a decrease in the official cash rate will almost lead to a decrease in the Australian exchange rate. This is because the flow-on effect will reduce the interest rate charged by banks, in turn no longer providing an incentive for foreign investors to invest in Australian assets, and in combination with our already low cash rate, this doesn't help, ultimately reducing the demand for Australian currency as well as increasing the supply of it, leading to a lower exchange rate. Thus, by keeping the official cash rate at 1.5%, neither of these outcomes will occur directly as a result of a change in the cash rate.
From ABC News research, the consumer view is that maintaining the cash rate will actually encourage a steady wage growth, which will help place confidence in Australian markets as Australia starts to move past this mining boom. Already in the last quarter, we have seen a 0.7% increase in the wage growth. Increasing job securities, Australians will now be able to start investing into the more competitive market. With commodity prices rising, sectors like agriculture, retail and infrastructure will finally start to see increase in economic activity as the globe starts to invest in other Australian sectors. Decreasing or increasing in the interest rate when the market's only starting to regain its balance will only lead to further instability once demand has been depleted. Over time, we'll see the inflation rate slowly make its way back to its target rate of 2 to 3% set by the RBA. So the general consensus tonight is from our experts is that the RBA will continue to maintain its official cash rate. That's all for tonight, and I hope you have a good evening.